India's trade deficit saw a modest widening in October, with exports seeing a sharp fall while imports have held up. While exports contracted 6.6% year on year, imports rose 5.7%. On a sequential basis, exports have contracted by 16%, while imports saw a contraction of 7.3%. To give us some more insight on the way ahead for foreign trade, we have Madhavi Arora, Chief Economist, joining us for a brief chat. Ma'am, thank you so much for taking time out.
Yeah, hi. Hi, Pallavi.
Hi. So, first and foremost, I just want to start off with your quick thoughts on these figures. Considering global growth impulses have been weakening, would you say that these figures are not entirely unexpected? And what's the way ahead?
So interestingly, since May, India has seen, the trade deficit only widening to the extent that it was initially the 20-25 billion kind of a range in the early part of the year, which is now shifted materially to the 20 to 30 billion kind of monthly range, which is obviously weighing a lot on the current account deficit in the first half of the year. Clearly, the kind of divergence that you're seeing in exports and import in terms of slowdown reflects the fact that the global growth is slowing much faster than India's domestic demand, which obviously is going to lead to a much wider trade deficit as we go ahead. And clearly, the fact that India is supposedly outdoing the rest of the world will also come with some cost, and that cost being a higher current account deficit. Because clearly your imports are showing much moderately compared to exports, which are linked to the global external demand, which probably will see a much harder adjustment in demand than the domestic economy. So clearly the divergence is now visible, but I'm hoping that the recent drop that you're seeing in the international commodity prices, especially crude oil, will likely start weighing on imports, and thus probably in the coming months you will see the deficit shrinking ahead.
All right. The drop in exports seems to be fairly broad based. There don't seem to be too many categories that have been left unscathed.
Yeah, so I think the biggest move that we saw in exports fall was petroleum products, whose shipment almost nearly halved between September and October. And I think a part of it could be driven by the export taxes, which were increased mid of this month. But at the same time, domestic demand also probably increased, into festive season. So that may have also led to much lower exports of petroleum goods. But I think they're now reaching more normal patterns that you saw pre, the Ukraine war. But that said, I think you rightly said that across commodities, you are seeing an export fall. Clearly, it's reflecting the fact that the global growth slowdown is, impacting your export much more meaningfully than initially thought.
All right. So, when we were recovering from the pandemic, at least some part of the economic recovery was kickstarted by very strong export growth. Now, with that weakening and outlook remaining fairly pessimistic owing to external factors, how does that bode for, domestic indicators?
Domestic indicators in a sense that, I mean, if you're looking at the external side of the economy, of course, as I said, that even though the divergence between exports and imports could continue, and you would have a much wider current account deficit, which could be to the extent of around 118 billion as per our forecast, which is around 3.4% of GDP, which is clearly much higher than the Reserve Bank of India's comfort zone, which in turn will imply that the balance of payment funding pressure will continue. So India would still need to lurch for foreign funds to ensure that we are able to fund the high current account deficit that we are going to be seeing this year. The only hope is that as we go ahead into the year, maybe the deficit should ideally come down, given that we are seeing a much lower increase in commodity prices ahead. And the kind of slowdown that we'll see globally should also augur well for the input inflation that we will see from the imported side. So all of it will obviously help you at the margin back home also, but it will also have come at the cost of a very sharp global slowdown, which will have implications for Indian growth story. So, while we could talk about India decoupling in the initial run because of India being a more domestic driven story, but I think it's a matter of time that India tends to catch up. The resilience aspect also comes with a cost, which is basically a much higher domestic demand, which is equal to a much higher current account deficit, which is equal to a probably a longish pressure on the rupee compared to other emerging market, if at all the Reserve Bank lets it, decide its fair value.
All right. And how much of a relief is in the given scenario then, how much of a relief is, a slowdown in global demand and in turn commodities expected to provide to this,
That depends
to
where it
exports?
ends, because one still doesn't know how, what is going to be the the impact and the depth of the recession that we are going to see globally. We are still debating whether it's going to be a hard landing
Sure,
or a
that's
soft
true.
landing. So that
That's
depends
true.
on how much of a damage that the global economy has to bear, which obviously will have implication on commodity prices. But obviously,
That's
India
true.
being a net commodity importer, it bodes well in terms of our import costs coming off substantially.
Right. And you did say that current account deficit, while this stage is going to be fairly high, it's expected to, get a little better going forward. So, would that be, could we expect some improvement in Q4 or a
Yeah.
little after that?
Yeah, I think no, you will see sequential improvement, in coming months, because we are seeing the commodity prices correcting right away. So I think going ahead, there will be a much lower deficit, getting into the next year, especially.
The central bank, though, does not seem to be as concerned about current account deficit at this point.
No, I mean, it obviously is a matter of concern, just that eventually the current account deficit pressure needs to be taken care of by either the rates market or the FX markets. So at this point in time, both of them seem to be looking comfortable. Obviously, rupee had seen its own challenges in the recent months, but because of the dollar, fall that one is seeing after the so-called Fed pivot and the much lower US inflation rate, print, I think across the world we are seeing a comfortable, currency-led rallies, and India also has enjoyed that. So I think to that extent, RBI is not too worried in terms of managing the current account deficit. We will be seeing a VOP deficit of close to 50 or 60 billion plus this year. So while the RBI may not be very open about the fact that current account is a problem, I think it clearly is beyond their comfort zone. But that said, on a more forward-looking basis, it should ideally sequentially correct, and maybe next year you should see a much lower current account deficit as well.
All right. Moving on to other external indicators. So, what's your outlook on the rupee? We have seen a little bit of a pushback, a little bit of an appreciation, but, what's the outlook here on?
No, so rupee clearly is at this point in time looks to be a function of what is happening around the world. In the last couple of months, rupee has been very well held by the Reserve Bank in certain instances, to the extent that it sort of outperformed most of its emerging market peers. And obviously, to that extent, it leads to pressure on the rates market to, sort of compensate for the kind of rupee movement that you are seeing. And to some extent, RBI also realized that it becomes counterproductive for them to not let the rupee find its own fair value, because that will come as a cost to the economy. And if the rupee corrects to the much fairer value, it would also lead to some kind of an automatic stabilizer for the economy in terms of better exports at a time when the world is slowing down and domestic economy is also going through its own imbalances. So I think there was a patchy period, of course, when the world was still looking for a pivot by the Fed. Now that it's very clear this point in time that a slower rate hike does not necessarily mean a lower rate hike, and one still doesn't know how long the global central bankers are going to be remaining restrictive in nature and how bad the recession is going to be. So I think to that extent, there could be still volatility which will be probably lurching ahead. But near term, I think the mood of the market looks to be more, EM FX friendly, and India is also enjoying that mood. And I think the movement that you saw in China, Chinese currency, has had a rip-off effect across Asian currencies, and India has also enjoyed that. So I think near term, you could still look at, India probably retracing the sub 81 print, but I don't think it will be sustainable. But that said, I think early part of next year, you should see more flows coming from the foreign investors across emerging markets, and I think India will get its fair share. So there could be a good chance by March that you're again looking at a relatively comfortable rupee, which will be hovering close to 8-ish. But near term, I think it could remain rangy. I don't see much downside from here.
Okay, one last question before I let you go. So, would it be fair to say that at this point we're seeing some fair divergence between high frequency indicators, a bunch of indicators like PMI has managed to hold up fairly well. Exports, for instance, have seen a share, a sharp fall because of the reasons you've discussed. All in all, what's your reading of the economy at this point?
No, I think it's quite mixed. External sector is sending a different signal. Domestic economy is also mixed. Even the festive, dealer conferences that we have attended so far in our firm as well are giving very mixed signals in terms of consumption behavior across rural and urban sector. So there is a patchy behavior in consumption. Investment again is a function of how secular the consumption turns out to be. So we'll have to see whether we are seeing an investment-led leg, which I don't think is the case. To watch out for. Government spending again looks to be a little cautious at this point in time. So I think getting into next year, which will be an election, pre-election budget year, we'll have to see how much the government actually spends in revenue expenditure as in capital expenditure, which could be having implication for domestic demand. And lastly, exports again looks to be a little patchy because of the weaker global demand that we have. So I'm still struggling to find secular demand indicators back home, which could lead to the next leg of India growth story. In the near term, I think it's pretty mixed. Growth should surprise on the downside. I think we should be ending the year at sub 7% GDP growth.
All right. Thank you so much for taking time out. Stay tuned to BQ Prime for more updates on the economy. Okay, ma'am. Thank you so much.